All right, good morning, afternoon, evening, whatever time of the day you're going to be listening to this recording. Today, we're going to be going right into chapter 3, the accounting information system. We have five major learning objectives. One, we're going to analyze the effect of business transactions on the basic accounting equation. Two, we're going to explain how accounts, debits, and credit are used to record business transactions. Number three, we're going to indicate how a journal is used in the recording process. Four, we're going to explain how a ledger and posting helps in the recording process. And then lastly, we're going to prepare our trial balance. All right, let's dive into it. Learning objective one, analyzing the effect of business transactions on the basic accounting equation. So using the accounting equation to analyze transactions. Now, what is the accounting information system? All right, this is the system of collecting transaction data. Is the process of processing the transaction data and communicating financial information to decision makers. Okay, that is the accounting information system. All right, so the accounting information system relies on a process referred to as the accounting cycle. Okay, and we have 9 of them. It begins with analyzing the business transactions. Then we do journalizing, and then we post. We have the trial balance. We have adjusting entries. We have the adjusted trial balance. We have the financial statements, closing entry, and the post closing trial balance. So 9 of them in total. So as we all know, like in our day-to-day or in real world, most businesses use the computerized accounting systems such as QuickBooks. All right, so what are accounting transactions? Transactions are economic events that require recording in the financial statements. Okay, so any economic events that will require you to record in the financial statements. Not all activities or not all transactions, right, will require you to record. All right, assets, liability, or stockholders' equity items change as a result of an economic event or activity. So whenever there is an event or economic event, right, our assets, liabilities, or stockholders' equity could either increase, decrease, or depending on what that economic activity is all about. All right, so and it always have a dual effect on the accounting equation. We're going to understand this as we go on. All right, identifying accounting transaction. Are the following events recorded in the accounting records? Okay, so we have our events. These are accounting events. When you purchase the computer, discuss guided trip option with potential customer, pay rent. Okay, the criterion is the financial position, that is the assets, liabilities, or stockholders equity of the company, do they change? So for example, with the case of purchasing the computer, is the financial position of the business changed? Do we record or don't we record? Okay, yes, right, because the financial position, the assets of the company is going to be affected. Okay, how about just discussing guided trips, options, and potential customers? No. Okay, no economic changes, right? How about paying rent? Of course, that affects what? Our cash, because we're going to have to pay money out, and that affects our expenses, which is under the stockholders' equity. So yes, we're going to have to record it because it's a financial event. All right, so for us to be able to know, for us to process our financial transaction, we should be able to analyze these transactions, okay, to understand what effect do they have on the assets, what effect does this transaction have on the liability, What effect does this transaction have on the stockholders' equity? And I want to believe that we still remember our equation. The equation that states assets is equals to liability plus stockholders' equity. Okay, we cannot forget. Okay, so when we talk about analyzing again, we're trying to find out what effect does the economic event have on the accounting equation. All right, so accounting equation must always balance, okay? The A, assets must always equals to liability plus the stockholders' equity. Each transaction has a dual effect on the equation. All right, so either one is increasing and the other is decreasing, or one is decreasing and the other side is increasing. So if an asset is increased, there must be a corresponding one, a decrease in another asset, or an increase in a specific liability, or increase in stockholders' equity. Okay, either of these three. So one asset increases, right? Another asset may be decreasing, a liability may be increasing, or increase in the stockholders' equity. Okay, so this is an expanded accounting equation. Remember, the basic is assets is equals to liability plus stockholders' equity. Okay, under the stockholders' equity, we have the common stock and the retained earnings. In order for us to get the retained earnings, I think we did this in chapter 1. It's your revenue minus your expenses minus the dividend. Okay, that gives you what we have in our statement of retained earnings, or in this retained earnings. So you want to have this at the back of your mind as we go through analyzing transactions and see how they affect each of these aspects of the accounting equation. All right, so we're going to deal with a couple of about 11 of these transactions. I want you to pay a close look and understand what is increasing and what is decreasing, or what is increasing and what is increasing. So depending, okay, but we're just going to read it and understand what is actually going on with this transaction. So event 1, on October 1, cash of 10,000 is invested in Sierra Corporation, right, by investors in exchange for 10,000 of common stock. Now, when we look at this event, what exactly is going on? We have 10,000 which this company invested. So that means our cash, what, for the business went up. Okay, that's an increase in our cash. And then we have 10,000 in common stock, which is also an increase in what? The stockholders' equity. There we go. All right, number 2. On October 1, Sierra borrowed 5,000 from Castle Bank by signing a 3-month 12% 5,000 notes payable. So he's getting a note payable. And I told you, every single time you see something payable, it's always a liability. Okay, so it's an increase in their liability because they have to pay. And it's an increase in cash because they borrowed 5,000, which increases the cash they have in hand. So our cash increased and our liabilities also increased. Okay, let's see how that goes. So you see the 5,000 increase and the notes payable increase. All right, number 3. On October 2, Sierra purchased equipment by paying 5,000 cash to Superior Equipment Sales Company. All right, so on October 2, we are told that he purchased equipment by paying cash. So that is what? A reduction in my cash assets, but an increase in my equipment, which is also an asset. So in this case, we have a reduction in one asset and another increase in another asset, because I paid cash, which is one asset, and I bought my equipment, which is also increase in asset, but the equipment, right? Assets. All right. Number 4. On October 2, Sierra received a 12,000 cash in advance from Arnox, a client. Okay, so this is a situation whereby a client is giving Sierra money ahead of time before the service is even performed. And like I've explained before, I think that was in chapter 2, You know, when we have unearned revenue, you are being paid, right, for services that you have not yet performed. So that's why we say cash in advance. Okay, so that's an increase in cash and assets, and also increase in liabilities, which is your unearned income. So we see that here, increase in cash and increase in our unearned revenue, service revenue. Okay, then number 4, on October 3, Sierra received 10,000 in cash from Copa Company for guide services performed. All right, on October 3, Sierra received 10,000 in cash from Copa Company for guide services that have already been performed. Okay, so how does this work? So they are receiving 10,000. That shows us that cash or the asset increases, right? And the services that were performed, that's going to be under the stockholders' equity, which is also an increase in revenue. Okay, so increase in asset cash, the asset cash, and then also increase in revenue, which is under the stockholders' equity. And that's why we had to show you, the extended version of the accounting equation. Okay. Event 6, on October 3, Sierra Corporation paid its office rent for the month of October in cash, 900. All right, on October 3, Sierra paid its rent. So cash, which is an asset, right, was reduced, and expenses, right? And because the expenses here reduces the stockholders' equity, it's also going to be a negative sign, 900. Okay, so there we go. A reduction in cash and also a reduction in the stockholders' equity. Okay, I'm really hoping that we are understanding the explanation. All right, event 7, on October 4th, Sierra paid 600 for a 1-year insurance policy that will expire next year on September 30. Okay, so they paid, that's cash, right? Cash was paid out. That's a reduction in assets, which is cash, and an increase in another asset, which is the prepaid insurance. So we have our 600 here, right? A reduction in one asset and an increase in another asset. Okay. Number 8, on October 5, Sierra purchased an estimated 3 months of supplies on account from Aero Supplies for 2,500. Okay, so this is another example that we have whereby Sierra purchased 3 months of supplies, right? So the supplies there is another asset, and the cash, oh sorry, it was purchased on account. I'm sorry. So each time we see anything that is purchased on account, we have to know that it is purchased, what we call credit. That means you have not paid for it. No cash was given at the time of purchase. So it's an increase in our supplies, right? And an increase in our liabilities. So 2005, increase in assets. Because it's an account, you have not paid cash for it yet. It's also an increase in your accounts payable, which is also a liability. Okay. All right, this next one, on October 9, Sierra hired 4 new employees to begin work on October 15. No accounting information. This is not an economic event. All we know that they were hired. They didn't tell us how much is paid. We don't know any of that. They have not even worked. We have not even exchanged that money. And so therefore, it's an accounting equation. An accounting transaction has not yet occurred. So nothing is going to be recorded. All right, event 10, on October 20, Sierra paid a 500 dividend. Okay, so $500 paid in cash, right? So that's a reduction in cash and also a reduction in your stockholders' equity, right here, because the dividend reduces your stockholders' equity. Okay, so a reduction in my asset and a reduction in our assets over here. Okay, so at the end of the day, we have employees have worked 2 weeks and they have earned 4,000 in salaries, which are paid on October 26th. Yay, which happens to be my birthday. All right, so October 26th. Now we are being paid, right? So let's see. Cash, of course, is a reduction in cash and also a reduction in our stockholders' equity. So we have 4,000 here in cash and 4,000 of the stockholders' equity. At the end of the day, because it has dual effects, okay, like we said, these two always has to balance, right? Our assets, we can see 23,300 actually equals the addition of our liability and our stockholders equity, which is 23,000 also 300. Okay, if you have questions, please don't forget to always log in to the office hours where we'll be able to answer questions that you might have. Okay. All right, transactions analysis. All right, so this is a table that you are being given and they want you to analyze it. Okay, they want you to look at it and imagine what would have happened. So a tabular analysis of transaction for the month of August is shown below. Describe each transaction. Okay, so we have our cash. So I'm seeing this number one to be an increase in cash and an increase in common stock. So it looks like, you know, there was common stock involved. Company issued shares of common stock for 25,000 cash. Okay. Number two, I see there is an increase in equipment, an increase in accounts payable. So my first thought is that they bought equipment, but they bought it on account. On account again means you did not pay cash for it. Okay. So company purchased 7,000 of equipment on account. There we go. So number three, I see 8,000 cash. That's an increase in cash. And then an increase in revenue. So either some services has been performed or yeah, some goods have been sold worth 8,000. So let's see. Company received 8,000 in cash in exchange for services performed. All right, so number four, I see 850, a reduction in cash of 850 and expenses of 850. So that means they paid cash, right? They paid cash and I'm seeing rent expense. So we had a reduction. That means this company paid $850 in cash for rent. Okay. So we have $850 for the month's rent. So I see the rent expenses just by the right hand side over here. There we go. All right, so learning objective 2, explain how accounts, debits, and credits are used to record business transactions. So how do we do our debits and credits? I know that's the most common words you hear in accounting. Oh, debited, credited, or debit balance or credit balances. Now we're about to find out. So debit and credit procedures, the double entry system. Each transaction must affect two or more accounts to keep the basic accounting equation in balance. So for the double entry system, like I always summarize, for every debit entry, there has to be a corresponding credit entry. Okay? For every debit, right, there has to be a corresponding credit entry. So if we looked at what we did in the first learning objective, we see that when we had an economic transaction, right, is either it's affecting asset and another accounting asset, or is affecting one part of asset account and then a liability account or a shareholders equity account. So we have to have that dual um, um, we have to have that dual effect. Otherwise, our assets will not eventually equals this liability plus stockholders' equity. Okay? So recording must consist of at least one debit and one credit every single time. One debit, one credit. One debit, one credit. Okay? So debit must always equal credit. Debit must equal credit. Okay? So if I'm putting $50 in credit in debit for cash, and I'm going to credit my liability, it has to be $50 too. Okay? It has to balance. Okay? So debit must always equals to credit. All right, so debit and credit procedures. Now, if debits are greater than credits, the accounts will have a debit balance. So at any point in time, if my debit side is more than the credit side, then we say we have a debit balance. Okay, so when we add up the 10,000 transaction 1 with the transaction 3 and deduct the credit side, which is 3,000, that gives us a balance of what? 15,000. Okay, because our debit side is more than the credit side, again, we say this is called a debit balance. On the other hand, if your credit side is more than the debit side, the accounts will have a what? A credit balance. In this case, our 3,000 plus the 8,000 transaction 3 minus our transaction 1, which is 10,000, gives us a balance of 1,000. So because our credit side is more than the debit side, I'm saying that we have what? A credit balance. Okay, we're going somewhere with all of this, okay? So just hang in there. All right, so procedures for assets and liabilities. Asset account, debit should exceed credits. So for all your assets accounts, your debit should always exceed credits. For your liability accounts, credits should always exceed debits. Invariably, we are saying that the normal balance for an asset account is what? A debit balance. And the normal balance for a liability account should be a credit balance. Okay, you want to be able to learn this, put this to heart, okay, so that you remember as we go through again through chapter 4, 5, 6. These are the things we're going to be saying. So you really want to take your time to understand, these things. Okay, so the normal balance again, okay, for the sake of repetition, for an asset account is debit and the one for liabilities is credit. Okay, the normal balance is the side where increases in the account are recorded. So every single time there's an increase in asset, you see the arrow going up, right? It's debit. Every single time you are paying out, right? And a reduction in your assets, that is a credit. Okay? So in the liability side too, our increase side is what? Credit. And so because the increase side is credit, that should be our normal balance. That's what the helpful hint is telling us. And when there's a reduction in our liabilities, then that is a debit. Okay. Investment by stockholders and revenue earned increases stockholders' equity as a credit. So for the stockholders' equity, increase in stockholders' equity is a credit, and a decrease in the stockholders' equity is a debit. The normal credit balance, right, for the stockholders' equity is a credit. So the normal balance is credit balance. Okay, and then we have the common stock. Okay, from the stockholders' equity, we have common stock, we have the retained earnings, and we have dividend. We also have expenses. Okay, so for the common stock and then the retained earnings, they all have the normal balance, right, of credits. Okay, the normal balances is credit. That means increase in common stock is credit, increase in retained earnings is a credit. For the dividend is paid out to the stockholders, and that reduces the stockholders' equity. And that's why the normal balance for a dividend account is a debit. Okay, the same thing goes for expenses. The normal balance for an expense account is also a debit because it reduces the stockholders' equity. Okay, so their normal balances for dividend and expenses is going to be the debit balance. Okay, dividend and expenses incurred decreases stockholders' equity with a debit. Okay, so that's why they are having a debit balance. Okay, so we have our revenue here and then our expenses. We've already explained this out. Revenue increases the stockholders' equity, and that's why a credit balance is the normal balance for the revenue. The expenses decreases the stockholders' equity, and that's why the normal balance for it is a debit. The effect on the revenue and expense account is the same as their respective effect on the stockholders' equity. So we're saying that since the revenue increases stockholders' equity, right? Since the revenue increases the stockholders' equity, that's why it has a credit balance. And the expenses reduces the stockholders' equity, and that's why it has a debit balance. So increase in expenses is debited, and a decrease in expenses is credited. Okay. All right, so this just summarizes all the rules we've just talked about. All right, that assets, expenses, and dividend all have debit balances. All your liabilities, revenues, and stockholders' equity have credit balances. Okay, so this is the summary. Increase in assets is debit, decrease in assets is credit. An increase in liability is credit, a decrease in liability is a debit. The equity is the same thing. Increase in equity is credit, a decrease in equity is debit. My apologies. An increase in revenue is credit, a decrease in revenue is a debit. Okay? And then lastly, an increase in expenses is debit, and a decrease in your expenses is a credit. Okay, so you look at the ways the arrows are going, right? So assets and expenses and dividend all have debit balances. Your liability, equity, and revenues all have credit balances. Okay, so you want to take this page is really serious. I can't say it more. There's no more way to say it. You just got to know it, learn it by heart, try to understand it, and then learn it. Because again, we're gonna go through this through to the end of the semester. Relationship among the assets and liability and stockholders' equity. Okay, we've seen it here again. The basic equation is the assets is equals to liability plus stockholders' equity. The expanded basic equation is where we have assets is equals to liabilities plus stockholders, right? And common stockholders' equity includes common stock plus retained earnings plus our revenue minus, right, the expenses, because expenses reduces it and the dividend also reduces it. The equation must always be in balance after every transaction. For every dollar of debit, there must be the same dollar of credit. Okay, you don't debit $50 and credit 20. Your account is not balanced. So if you are putting $50 in debit, you have to put $50 in credit. If you put 1 cent in debit, you have to put 1 cent in credit. Okay, for every dollar of debit, there must be the same dollar of credit. Okay. All right, now we're going to go into learning objective 3, okay, where we're going to be talking about the journal, okay, recording of the journal, okay. So this is going to be the second part of our accounting cycle. So we have steps to record in your journal, the recording process. So analyze each transaction in terms of its effect on the account. And that's what we did. We did like almost 11 examples. You want to analyze it. What went up, what went down. What account, assets, liabilities, stockholders' equity. Then you want to now enter this information in a journal, right? And number 3, transfer the journal information to the appropriate accounts in the ledger. Okay, post to the ledger. Okay, so this is what it looks like, the recording process. So we analyze bill to Sierra, right? Superior Equipment Sales, they billed Sierra because maybe Sierra paid for it with cash. All right, examine the source document and determine effect on the account. All right, so Sierra purchased the equipment for 5,000. Now we put it in our journal. We now see what a journal looks like. It has the date, the explanation of title. These boxes here we're not saying is the debit and then the credit. And then this is what our ledger looks like. It's what we call the T account. It's a T-shaped. The name of the accounts here, we have cash account, we have equipment account. These two are all assets, okay? So we have our cash and then we have our equipment, and this is what the journal looks like. This is what this is not exactly what it looks like. We're gonna have examples as we go, but this is what their invoice is at this time. All right, so transactions are recorded in chronological order in a journal. So as it happens, date by date, August 1, August 2, August 3, August 4, August 5, like that in chronological order. All right, before they are transferred to the account. All right, so we had an example of the account in the last slide. This is it. It's more or less like the T ledger. Okay. Journal contributes to the recording process because it discloses the complete effect of a transaction. Okay, and then it provides you with the chronological records of the transaction. Say you want to look for a transaction, it's easier to find it on the ledger to know, oh, what date are we looking about? 10. Then you go to the 10th day, right? Because you are recording the journal in chronological order. Then it helps to prevent or locate error because the debit and the credit amount can be readily compared. So when you record in journal, it is easy for you to see the debit side and the credit side. You know when you put $50 in the debit and $500 in the credit, right? Because it's easy for you to see at a glance compared to that of a ledger. Because for the journal, everything is in one place. Okay? All right, so let's look at this example. The process of entering transaction data in the journal. Okay, so illustration presented below is information related to Sierra Corporation. October 1, Sierra issued common stock in exchange for 10,000 cash. That's the first thing. October 1, Sierra borrowed 5,000 by signing a note. October 2, Sierra purchased equipment for 5,000. Journalize the transaction. So the first thing we're going to do again is to analyze these transactions in the chronological order. Okay, so let's do it. The first one. All right, so October 1, Sierra issued common stock in exchange for cash. What accounts are affected? We have the cash account, which is an asset, and we have the common stock, 10,000. Okay, all right, we've learned how to analyze. All right, now we want to put it in the journal. Okay, now this is what a journal looks like. We have the title, the general journal. We have the date, account titles and explanation. You have the debit, and then you have the credit. Again, whatever amount you put in the debit must always equal to the amount that you put on the credit side. All right, so our date here is 2022, and the first one here is October 1. We're saying that cash increased, right? And once we have an increase in assets, what are we supposed to do? We are going to debit. Once we have an increase in stockholders' equity, what do? We credit. Okay? So in this case, for every debit entry, we already have a corresponding credit entry. Okay? And again, it has to be in chronological order. All right. Also, October 1, Sierra purchased 5,000 by signing a note, right? So when he signed note, he borrowed 5,000. That was an increase in our cash of 5,000 and also an increase in the notes payable, which is a liability. Again, anytime you see a payable, you know that that is a liability. Okay? And when you see a receivable, you automatically know that that is an asset. Okay? All right. So we have cash of 5,000. That's the debit. Okay? Because our cash is going to increase by 5,000. And then our notes payable, right? Which is 5,000 increase. That is 5,000. So our assets increase, right? 5,000 is debit. And then an increase in the liability of 5,000 is the credit. So for every debit entry, we also have a corresponding credit entry. Okay, I want to believe that we are following. Again, if you have questions, please come up on the question and answers during the office hours. I'll be more than happy to explain more to you so that you can understand. October 2nd, Sierra purchased equipment for 5,000. All right, so we purchased equipment. That means we are buying. Cash went up. And because cash is decreasing and equipment is increasing, so we have an increase in assets, right? Is a debit, which is the equipment, 5,000. And decrease in the asset, which is cash, is decreasing. We have a credit balance, okay? So for every debit entry, we also here have a corresponding credit entry. Okay, so equipment increased and our cash decreased. Okay, all right. So this is a summary of all that we've done. Okay, so I'm going to just go through. You see the title here. General journal. We have the date, the account title, and explanation. Right? We have debits and we have credits. Okay, October 1. This was for the other one. For debit entry, we have a corresponding credit entry, the same amount. And that's why we say one of the advantages that when you look at the general journal, you can see at a glance where you make the mistake. Two, it is recorded in chronological order. Let's say I'm looking for a transaction that happened on the 2nd of October. It's so easy to identify, right? Because it's recorded in chronological order. Okay? And then we see the last part is the explanation of what happened. So that anybody who reads the journal has an understanding, of what actually happened. So here we have for October 1, issued stock for cash, right? So immediately after every journal entry, you want to be able to put a little explanation in your own words and in clarity, such that anybody who reads this journal, even when you are not there, has the ability to understand what the transaction is all about. All right, so the other description here says issued 3 month 12% notes payable for cash. As simple as that. Again, it's in your own words, but something that anybody who reads it is able to understand. Okay. All right, this is a do it. I want to see. Can you try? Pause and try this on your own. See if you get it. Okay. The following event occurred during the month of business of Hair Inc. Okay. Kate Brown Beauty Salon. All right. So issued common stock to stock shareholders in exchange for 20,000 cash. Number 2, purchase 4,800 of equipment on account. Anytime you see on account, it means that cash was not exchanged at that time. It was bought on credit. To be paid 30 days. So they purchased it for 4,800. The vendor wants them to pay for this equipment in 30 days. All right. So interview 3 people for the position of a hairstylist. These 3 activities are recorded as presented in the next slide. So try it on your own first and see if you get it, and then we can go from there. All right, so the first thing, issued common stock in exchange for 20,000. That is an increase in cash and an increase in common stock. Increase in cash, which is an asset, is a debit. Increase in common stock is a credit. Okay, so cash 20 and our common stock 20. Purchase 4,800 of cash equipment on account. That's an increase in cash of 4,800 and an increase in our liability of 4,800. So that's the accounts payable. For the interview 3 people for the position of hairstylist, no entry is necessary because it's not like an economic event that needs to be recorded. All right. Again, if you have questions, come up during the office hours on Thursdays from 12 to 1. All right, so learning objective 4, explain how a ledger and posting helps in the recording process. Okay, once you are able to grasp the understanding of learning objective 2 and 3, 4 and 5 are pretty good to go. But I'll keep re-explaining the things that we've done so that you can have that understanding can be drilled right into you. So we have done the analysis of business transaction. That's part of our accounting cycle. We have dealt with journalizing transaction. The next thing will be to post to ledger accounts and then to the trial balance. Okay, and then the adjusted entries, and then the adjusted trial balance, and then the financial statement, and then the last one is the closing entries. But right now we are posting to ledgers, post to ledger accounts. Okay. All right. So the ledger is comprised of an entire group of accounts maintained by the company. So under the accounts, asset accounts, you could have equipment account, you could have a land account, you could have supplies account, you could have cash account. What are the other assets that you know? Accounts receivable. You could have prepaid. Okay, whatever accounts that you have as a business could be under the asset account, right? Everyone that qualifies to be an asset will be under the asset account. Under liabilities, again, anytime you see payables, right? Payables are always liabilities. Like, don't even miss it. Liabilities, payables, okay? So we have the interest payable, the salaries and wages payable, accounts payable, notes payable. All of these are liability accounts, okay? And then we have the stockholders equity account. Under that account, we have the salaries and wages expense, okay? We have the service revenue, we have dividend, we have return earnings, we have the common stock, okay? So we want to have this at the back of our minds, again, as we go. Everything we're doing in this chapter, stay true to chapter 4, you want to keep this to heart, very dear to your heart, okay? All right, so charts of accounts. All right, the number and types of accounts used differ from companies depending on the size, right? The complexity and the types of business. All right, so every business has their different kinds of charts of account. It just depends, on how big the company is and what they decide to use. So, for example, the number of accounts depends on the amount of detail desired by the management. The management of one company may want one single account for all types of utility expenses. Another may want to keep separate accounts for each type of utility expenditure, like for gas, electricity, rent, and all that good stuff. Okay, so it depends. The chart of account depends from company to company. Okay, so for the sake of this, accounts in red are used in this chapter. So we are using the cash account, the accounts receivable on the asset, supply, prepaid insurance, and equipment. All right. For liability, we're going to use notes payable, accounts payable, unearned service revenue. Do you remember this? I explained this already. Common stock for stockholders' equity, returned earnings, dividend. And on that revenue, we have revenue, service revenue. On the expenses, we have salary and wages expense, and we have rent expense. So these accounts could go on and on and on, depending on what each company desires. But I want you to just have it at the back of your mind, right? That this is right the charts of account. This is the list of accounts that companies could have, right? So under assets, again, these are what you could have: liabilities, stockholders, revenue, and expenses. Okay. So the posting process. Now that we already have what we have in the general ledger, still with the same questions, whatever we have, right, in the cash account, we draw a T and have cash. We debited it in the journal, we debited in the when we post to the account. So post the amount of the debit entry to the debit side of the accounts being debited. So we had it on the debit side of the journal. It comes to the debit account, the side of the account. So the left hand side is the debit, and the right hand side is always the credit. The left hand side is always your debit. The right hand side is always your credit. Okay. So whatever you did, your analysis, you got it correct in the journal. All you have to do is to transfer it, debit to debit and credit to credit. So now we have our cash account 10,000 and our common stock October 1 10,000. Okay, posted on the credit side. There we go. Okay, there we go. Okay. Recording process illustrated. Steps to recording process. Determine what types of accounts are involved. Okay, cash account, equipment account, prepaid insurance. That's for assets. For expenses, could it be rent that you have to pay? Could it be telephone expenses? Could it be salaries and wages? right? You want to be able to determine what accounts are involved. Then determine what item increased or decreased and by how much. Translate the increases and the decreases into debits and credits. Okay? All right, so let me just reiterate. An increase in assets is debit. A decrease in assets is a credit entry. An increase in liability is a credit entry. A decrease in liability is a debit entry. For stockholders' equity, right? For the common stock shareholders, we have an increase in that gives us a credit entry, and a decrease in that gives us a debit entry. How about for revenue? Increase in revenue is credit. A decrease in revenue is debit. Increase in expenses, debit. Decrease in expenses is credit. I just wanted to say that again. Okay? So, recording process illustrated. On October 1, stockholders invested 10,000 cash in an outdoor guide service company to be known as Sierra Corporation. Okay? Our analysis is that the cash is increased by 10,000. Stockholders' equity, specifically common stock, is increased by 10,000. Okay? So we said increase in cash, increase in stockholders issued stock. So we have debit increased assets, right? Cash 10,000. Credit increases stockholders equity. Credit common stock 10,000. That was how we recorded it in the journal, right? And because we already got it right in the journal, we just transfer. 10,000 is the debit side on our cash account, and 10,000 is credited on our common stock account. Okay, I'm hoping that we are good. So basic analysis, equation analysis, debit credit analysis, then you put in the journal entries, and then you post to the ledger. All right, so event 2, right? We have on October 1, Sierra borrowed cash of 5,000 by signing a 3 months 12% 5,000 notes payable. The basic analysis, right? The asset cash is increased by 5,000. The liability notes payable is increased by what? 5,000. Okay, we talked about that in previous discussions. So assets, which is cash, in this case, our cash account is increased, right? And the liabilities also increase. An increase in assets is debit. An increase in liability is credit. So cash is debited 5,000. Our notes payable, which is a liability, is credited 5,000. Because now that we have this analysis, we can easily post to account. So again, October 1, we have 5,000 under the same cash account, and notes payable, right? 5,000. Okay. Okay. All right, so event 3, on October 2nd, Sierra used 5,000 cash to purchase equipment. The asset equipment is increased, so that's an asset account is increased, and the asset cash is decreased. Okay, so assets cash, right, is decreased by 5,000. Our equipment is increased by 5,000. Okay, debit increased assets, debit equipment 5,000. Credit decreases assets, credit cash of 5,000. All right, so when we post to the journal, we have an increase in equipment 5,000, a decrease in cash 5,000. Now in our cash account, we have October 2nd 5,000, and equipment we have 5,000 because in debit, because it's an increase in the asset account. Okay, October 4, on October 2nd, sorry, event 4, October 2nd, Sierra received a 1,200 cash advance from Aaron Knox, a client, for guide services for multi-day trips that are expected to be completed in the future. The asset cash is increased by 1,002. The liability is an unearned service revenue is increased 1,200 because the service has not yet been performed. All right, that is when an advance payment is received, unearned revenue should be recorded in order to recognize the obligation that exists. Okay, so we explained that before. Because they have not performed it, it's still a liability to them. All right, so assets again equals to liability for stockholders' equity, right? We don't want to forget that, right? So increase in our cash, but also increase in liability, which is unearned service revenue. And every time we have an increase in cash, you debit. You have an increase in liability, you credit. So we have in our journal cash debited and unearned revenue, which is a liability, credited. We post that to our account. So cash account on the 2nd of October is 1,002, and for the unearned October 2 increase in liability is 1,002. You see how we are accumulating under cash account, right? So this is from the all the events that we have done. We have 4 of them, and most of them have affected the cash account. All right, so event 5. On October 3, Sierra received 10,000 in cash from Cooper Company for guide services performed in October. The asset cash is increased by 10,000. All right, so and the service revenue is also increased by what? 10,000. Okay, so assets cash, right? That is 10,000 because it's an increase. And then increase in revenue is a credit, and that's why we are crediting our service revenue. Under the journal entry section, we have cash, which is increased by 10,000, and service revenue, received cash for services performed, 10,000. Okay, so that's service revenue 10,000 and cash increase 10,000. We bring our to post to the ledger. We have a debit for cash account, and then we put it under the debit as October 3, 10,000, and our service revenue and a new account also October 3 for 10,000. All right. Event 6. On October 3, Sierra paid office rent for October in cash, 900. All right. Basic analysis. The expense account records rent expense is increased by 900 because the payment pertains only to the current month's rent. The asset cash is decreased by what? 900. All right, so we have 900, right? And stockholders equity expense 900. All right, debit increase expenses, debit rent expense 900, credit decrease assets, right? Credit cash for 900. Okay, so here we have rent expense 900, cash that was paid for it 900. Okay, and so because we paid out money, which is a reduction in our assets, we have 900, right? And then our rent expense is a debit. We have it for 900. On October 4, Sierra paid 600 for a 1-year insurance policy that will expire next year on September 30th. Okay, the cash assets is decreased under the basic analysis at 600. Payments of expenses that will benefit more than one accounting period are identified as prepaid expenses. So because we have paid for more than the accounting period in which we are, therefore it is going to be termed as what? A prepaid expenses. Okay, so when a payment is made, an asset account is debited in order to show the services or benefit that will be received in future. Therefore, the asset prepaid insurance is increased by 600. Okay, whereas cash is reduced by 600. So increasing assets, that is debit purchased, right? Debit, okay, And a decrease in cash is credit. So we're going to credit cash account by 600. Okay. So in our journal entry, we have prepaid insurance increase in that, which is an asset, is debit, and cash is reduced. So a reduction in our cash is credit 600. All right. So posting to ledger, October 1. No, sorry, not October 1. We have October 4, $600. Okay, what we used to pay for prepaid insurance. And then under the prepaid insurance, sorry, we have $600 October 4. Okay, I want to just encourage us, rather than just look at me read through, it would be really nice if we can go through, questions on our own. Okay, to see how we're doing. Okay. So example or event 8. On October 5, Sierra purchased an estimated 3 months of supplies on account from Aero Supplies for 2,500. The asset supply is increased 2,500. The liability account payable is increased by 2,500. So since we bought supplies, which are an increase in assets, is debit, an increase in liability is also a credit. It's a credit entry. Okay. Anytime you see account, remember you bought it on credit. Okay. What is the equation analysis? Is an increase in our assets, which is supply, and an increase in our liability. Okay, so debit supplies 2,500 and credit accounts payable 2,500. Supplies 2,005, accounts payable 2,005. We transfer that to our ledger account. October 5, supplies 2,005 and accounts payable October 5. You see here that we didn't affect cash because it was bought on account. So the cash account was not affected at this time. Okay. On event 9, October 9, they hired 4 employees to begin work on October. Each employee received a weekly salary of 500 for a 5-day work week payable every 2 weeks. First payment will be made October 26th, right? So there's just an analysis, but there's no need for to record the transaction. Our first economic transaction will take place October 26th when they make their first payments. All right, on October 20, Sierra paid a 500 cash dividend to the stockholders. Yay, they were able to get money, right? So the dividend account is increased 500 and the asset cash is decreased 500, right? We said that an increase in the dividend account is a debit and a decrease in the dividend account is what? A credit. Okay, so we have a reduction in our cash, right? And then we have this increase in our dividend because it was paid out, right? So we have debit dividend account for 500 and credit cash account for 500. All right, so we have dividend 500, cash 500. Okay, declared and paid a cash dividend, right? Because a reduction in our cash. Okay. All right, so on October 26th, Sierra paid employees salaries of 4,000 in cash, right? So the expense account, so what are the accounts involved? We have the salaries and wages expense, and then we have the cash because cash was given out. So cash account, 4,000, and then we have our salary expense also of 4,000. Okay, increase in expenses with debit, decrease in assets we credit. So we debited salaries and wages expense account for 4,000 and we are crediting cash account for what? 4,000. Okay. So we see it in the journal entries here. Salaries and wages expense 4,000, cash 4,000, right? So these are the salaries that were paid. And then under the cash account, we see that on the 26th, we had 4,000, credit because it was a reduction in our cash. And then an increase in the salaries and wages, which is a debit balance. Okay. All right, so this is a summary of everything that we have done. This is what it should look like one general page of general ledger per, period. Again, it's recorded in a chronological order. We're able to see that we pay 10,000 here, 10,000. Like, you are able to see clearly at a point. No, even if there's error, you are able to see where your error is. Okay, so this is the summary. Okay, and you see how they put the notes, just a little note. Again, this could be in your own words, but something somebody will read, and even if you're not there, they will understand what transaction took place. All summary of what we've done. And this is also the summary for the ledger, right? Now, this is an asset, right? We have our assets, and we said assets would usually have a debit balance, and that's what we have here. And we're saying that the debit side for the cash account is more than the credit side. Okay, when you add up the debit side and subtract the credit side from it, you're going to have a balance of 15,200. And that's why we have it here as balance. The same thing with supplies. There's nothing on the credit side, so the balance invariably is 2,500. The same thing with prepaid. Same with notes payable. We see that formula is consistent, and that's why many times, when people look at their account and they see that they have a negative balance in their assets, you want to find out why. Why do I have a negative balance in an asset account? There must maybe an error, or you are spending more than you actually have. All right. We look at the notes payable. It's a liability. Accounts payable. It's a liability. We see that all the liability accounts all have what? Credit balances. Okay. The service revenue also has a credit balance. The common stock also has a credit balance. We said dividend has a what? Debit balance. Salaries and wages has a debit balance. So we have the salary, wages expense, rent expense, all showing that they're all debit balances. It's not going to be normal for them to have credit balances. Okay, so this is just a summary of everything that we have done or explained in the previous slides. All right, this is something that you can do. Do you want to try it on your own? Just take time to try, see if you are able to do it. All right, so this is pretty simple because they've already analyzed the transaction for you, and all they want you to do is to post it to a T account. Again, once you have your journal set out, you have your cash on the debit side, you put it on the debit side of the T account. You have the common stock, put it on the credit side. So the debit and the credit, which seem to be the little challenge for students when they're first learning this, has already been done for you. Okay, so we have our cash account, we have our accounts receivable, I have common stock, I have service revenue. Okay, so let's see. Debit, cash, 30,000, 30,000 credit. Okay, common stock. Accounts receivable is a debit in the journal. It's going to be a debit in the accounts receivable. Service revenue is credit. It's going to be credit in the ledger. Okay. Cash account is 4,000. Debit, we have it as 4,000 in the ledger. Accounts receivable is 4,000 credit. Is 4,000 credits in the accounts receivable ledger account. Okay. I know this is a lot to soak in and take in. Make use of the tutorial center, the times and the hours that they're giving to you. Make use of it. That's why they're there. If you have questions, come up during the office hours. I'll be more than happy to help you with whatever questions, homework that you need to do. All right, so the last thing we're going to do for this class is to prepare a trial balance. Right, again, we're going through the accounting cycle so that you know where we are per time. So analyze the business transaction, journalize, post. Now we're going to do prepare the trial balance. Right, in the next class, that's chapter 4, we're going to do adjusted entries, adjusted trial balance, I think the financial statement and closing entries, and post-trial balance. Okay, so let's deal with preparing the trial balance. Okay, so nature of a trial balance. The trial balance is a list of accounts and their balances at a given time. Accounts are listed in the order in which they appear in the ledger. Okay, so a list of accounts and their balances at a given time. right? So once we bring out all the accounts we had, maybe for the month of October, right? Where we had a debit balance, we put it on the debit side of the ledger, and where we had a credit balance, we put it on the credit side of the trial balance. Okay, accounts are listed in order in which they appear in the ledger. So I'm going to show you what that means. So it's going to go in order right there. Assets first, then the liabilities, then the stockholders' equity, then the revenue and the expenses. So this is the order in which you have to list your trial balance. Okay. Purpose is to prove that every debit you entered is equals to every credit. So the trial balance, like the name suggests, is a balance that gives you understanding of if you have actually entered your numbers correctly. Okay? So where you have $50 in one place that you have not entered $500 in another place. At the end of the day, if you have entered everything correctly, your debit side should eventually equal to the credit side. Okay? May uncover errors in journalizing and posting. So there's every tendency that your trial balance will expose errors. Okay, but there are certain errors it will not expose, and we're going to get to that in a minute. Useful in the preparation of the financial statement. So many times we use the trial balance to prepare our financial statement. Once we are sure that the trial balance, it tells, oh, you're good, and then from there we're able to prepare the remaining financial statement, all the financial statements. So the trial balance, this is what it looks like. You have your headings, the trial balance, the dates, okay? Debits and credits, and then you list them in order like we said. So from the question we did before, again, most of these things in the PowerPoints can be found in your textbook. So for this one, we can find the trial balance on page, we can find it on page 330. Okay, that way we can flip back to see the accounts we did before and see how the numbers look like. So in our balance for the cash accounts under what we did before, the balance was a debit balance and it was 15,200. All right, we also had supplies, it was 2005. We had prepaid insurance, it was 600. We have equipment, we had it at 5,000. Now we have notes payable, 5,000. Accounts payable, 2,500. On end service revenue, 1,002. Common stock. So we see how we are arranging them. We have our assets first, and then we have our liabilities, now the stockholders' equity. All right, so we have the common stock, 10,000. Then we go to dividend, 500. Then we're going to deal with revenues, right? How much was that? 10,000. Now we have our salaries and wages expenses, and we will have rent expense, okay? And that brings us to a total of 28,700, 28,700. See, our debit side is equals to the credit side. So a part of us is like, yes, we got this together. If you don't get it right here, there's no need moving forward, to go do any financial statement because your balance sheet will not balance at the end of the day. So if you get to this point and you're missing something, then you want to go back to find out what you actually missed or what you actually did wrong before you move any further. Okay. All right, limitations of the trial balance. The trial balance may balance even when a transaction is not journalized. So just in case you didn't record journalize one of the transactions, say somebody came to buy stuff worth $400 from your store and it never showed up in your balance sheet, in your journal entry, then it's going to balance regardless. It's just that you are missing something. Okay, a correct journal entry is not posted, right? So you have a correct journal entry, but you did not post it, right? Then your account is still going to balance. If you enter a journal entry twice, say the $400 was entered, it entered the first time, you entered it the second time, at the end of the day, debit is actually going to equals to credit. All right, if you put in incorrect amounts and then you post them debit credit. So for example, I had, say, the $400, right? Instead of putting 400 in my debit, I put 40, and in my credit, I put 40 also. At the end of the day, my debit is also going to equals to what? The credit. Okay. Offsetting errors are made in recording the amount of the transaction, right? So offsetting errors. So I put 40 somewhere and I put a different number, and then I have another error that offsets the error that I did initially, then that's also going to make my trial balance to balance. And those are some of the limitations of the trial balance. Okay, so this is an example of our, for the trial balance, for us to try. So the following accounts come from the ledger of Snow Gold Co. Corporation at December 31st, 2020. Prepare a trial balance in good form. Okay, so we want to follow the order. You know what balances this should be, and so let's go. Okay, we already have our names, the trial balance, the December 31st, 2022. All right, so cash is a debit balance. We all know that. Accounts receivable, all assets have debit balances. Okay, so we just put them under the debit side. Okay, assets, equipment. Under notes payable, we know that's a liability. Okay, and liabilities have credit balances. There we go. Common stock. Then we're going to have a revenue, dividend, then revenue. Dividend has a debit balance. Service revenue has a credit balance. Expenses has what balance? Debit balance. Okay. At the end of the day, we see it balances up 1,158,000. Our debit side equals to our credit side. I know that this has been a lot to take in. I want you to spend as much time as you have. Give yourself time to understand this concept. I always say, well, if you have to put it under your pillow to remember, if it works for you, yes. If you have to put it up on the ceiling to remember, like when you wake up in the morning, that's what you see. Please do whatever works for you to get this concept in. Once we're able to go through the first 4 chapters again, it becomes a little bit better. Okay, but you want to understand what this accounting equation is and how they work. Okay, I'll see you in chapter 4. Thank you and have a good day.